went to business school, I went to Harvard. During that time, I did my summer internship in London, also doing emerging markets investing, specifically trying to be like, is this something I want to do long term? I'm just going to like deep dive into it, and decided, okay, I'm going to focus on emerging markets for the full summer and just specifically Africa, and see if industry agnostic, but geographically specific, if this is something I wanted to do.
You said you have some wild stories, so
what would be like the most common and viable routes for these companies that went public and then now doing poorly in the fintech space,
at least with venture, people understand they're going to be, not revenue generating for a while. They understand that this is a long-term bet. Retail and public investors, they don't have those same timelines. Well, at least the majority don't.
With soft skill and especially the technical skill that the growth equity investor is going to need.
This company in the future, when it exits, hopefully by public, will be using comparables. Not only are you being able to take any type of financial statement that a company is giving you and then run scenario analysis on it of different growth profiles or different growth scenarios, then you're able to put together a valuation analysis based off of a number of things that could happen to that company.
Felt like a cheat answer because still investing related, but anyway, I'll take that.
Hello everyone, this is Vu, and welcome back to another episode of For Vietnam podcast. Today we have Vu and Chi also. Phương Yi is going to be co-host. Is a friend of ours in New York City working in investment banking. And then we have Vanessa Trịnh. She's actually a former colleague of my neighbor. Vanessa got a very diverse range of background from banking, investing across different stages as well. So we'd love to just hear more about that during this episode.
Sure. Thanks for having me. I'm glad we could make this work and find the time. My name is Vanessa. I am originally from the Washington, D.C. area. That's actually where I live right now. As you mentioned, my background has been quite diverse, but has been in finance for a very long time. I did my undergrad at Dartmouth, and I studied economics and government. During that time, I did my internship at PIMCO. That's where I did my first job after college. I was at PIMCO. I started on the trade floor, actually, and then moved to their private equity firm or fund, where I invested in everything from real estate to financial services, special situations. And so I did 2 years at that fund as kind of really their first associate. They didn't really have, especially first-year associates outside after college. So I was one of the first ones to do that. And after 2 years there, I actually went to the IFC and I joined their tech investing group in Washington, D.C. Part of that was to move closer to the family. But then also, I really thought about doing emerging markets. I think after learning my investing fundamentals at PIMCO and doing something for like a really big asset management firm like PIMCO, I thought about, okay, how can I do this with some sort of impact as well? And so the IFC and development finance was something I wanted to learn more about. So I spent 2 years there, mostly investing in technology companies in Latin America, South America, and Sub-Saharan Africa. The IFC's mission is really to finance emerging markets. And so I really got to learn a lot about that. After the IFC, I went to business school. I went to Harvard. And during that time, I did my summer internship in London, also doing emerging markets investing, specifically trying to be like, is this something I want to do long term? I'm just going to like deep dive into it. I worked for a fund that kind of like an investment partnership with TPG Rise, and specifically decided, okay, I'm going to focus on emerging markets for the full summer and just specifically Africa, and see if industry agnostic, but geographically specific, if this is something I wanted to do. I ended up not deciding to do emerging markets after that summer, but it was awesome to just really know that, honestly. And I also spent the summer in London. I came back, finished my MBA. I also founded a startup during that time, and afterwards went to work for a growth technology firm, investing in, I would say, growth stage venture and technology companies based out of SF called Explorer. They also ended up doing SPACs. 2020 was the crazy time of SPACs, so I have some Wild West stories about that if you guys want to hear about that. So I actually got to like underwrite multiple SPACs. I closed the SPAC deal, like it's crazy. But the SPAC that I worked for, it was actually a really, boring software company. It was like a regular B2B SaaS company, which actually did kind of well. So interestingly enough, After that, I ended up joining Twilio because one of the board members at Twilio was actually CEO of one of the SPACs that I underwrote. And so Twilio was thinking about building out their own venture arm at the time. And I was introduced to the woman who was building out that effort. And I ended up helping to build out Twilio's corporate venture arm, as well as they had their own like startup and business development program that all fed into their larger venture arm. And so I was there for about a year and a half before I actually left to join Ampla, which is where I met Kang. And Ampla was in New York City. I was trying to figure out a way to get back to the East Coast. I'd been in California for a bit then. And also I knew a board member at Ampla and had been investing in fintech for a while, but hadn't really been on the operator side. And so led the partnerships effort at Ampla and also the venture effort there for a little bit of time before I realized that Ampla, being a Series A startup, really had other things that they needed to focus on and decided that it wasn't necessarily all it was cracked up to be. And that's part of the reason we love startups. Some of them work and some of them don't. But I left there and actually went to WEX, and WEX has its own venture capital fund. I was employee number 2 there. I lead all of our portfolio management. We invest in Series A startups, check size between 2 to 5 million, looking at everything from mobility and the energy transition and fintech startups at the early stage. That's where I'm at now.
Wow, such an extended list of experiences. Probably you're the guest that has the longest resume. If you could list out all the jobs and then bullet points. And we'd love to hear more about your SPAC experience. I wonder if you met the SPACing Chamath at all, because G here on our show, he's the biggest fan of Chamath. I'll have it here on the SPAC. But any crazy story about the SPAC? Yeah, before we dive into more questions, you said you have some wild stories. So
well, I mean, it was just, honestly, at that time, it was the Wild West. There were no rules. There were just like anyone that wanted to do this could. You just registered, filed certain amount of documents. You didn't even have to put up very much equity at all. And literally any one of us could have been CEO or CFO of a SPAC. Like, wow. You just registered and you didn't need to have qualification. I mean, the SPACs that I worked on did. We actually had really legit, like, former tech CEOs and CFOs. And that's part of the reason I was able to then go to Twilio afterwards with the support of a board member. But there were plenty of SPACs that we were seeing at this time. And at this time, you were seeing dozens of SPACs come out every day from just random people, not necessarily banks, not necessarily investment groups, just like groups of people that decided to do this. And I was only doing this SPAC thing for like a year, but I met in that year like over 200 of the biggest tech companies because every single one of them was considering doing a SPAC. I met the CEO of SoFi. I met the CEO of GoFundMe. I met like all these people who you don't necessarily would think about as like SPAC candidates, but everyone was a SPAC candidate at that time. And I looked at everything from, a boring B2B SaaS, Microsoft partner, ecosystem partner, all the way to rockets and like everything in between, gaming technology. It was just everything. And everyone was kind of making it up as they go to a certain extent. It was just fascinating the types of people that you would get into a room because everyone kind of understood that it was a bit of a gold rush and everyone felt that energy on these calls. But we kept doing it, right? And even us as SPAC sponsors, who are theoretically the people that actually make money in the you kind of understand that the whole game is that retail investors get screwed over. And that's just something you just do over and over. And you just kept doing it. And the market kept propping it up. But regulation was also changing in like real time, and market conditions and the way that you underwrote these deals would change in real time. So like one day the SEC would like issue a rule and then we had to go and change all of the documents we just filed that next day. And then a week later they would issue a different rule and you change them again. And it was just like, that's how reactive it was and how in real time the market was changing. All of a sudden, sponsor rates or promote rates would change from X% to another percent. And that would change on a weekly basis. And so this market was constantly changing in front of you.
So just for the audience that might not know about the SPAC, like I don't really understand about the SPAC. Let's assume
Yeah.
so. So this is the simplifying term and the way that I thinking about SPAC. You know, for example, if you have a company and let's say like a small startup or big size startup, and the process to go IPO is very complicated, and you know you have to check a lot of box in order for you to qualify to go IPO in the Wall Street. So you know another way that people figure out that can get you on the floor or get you on the listing and
Yes.
secondary market, which is going through SPAC. So SPAC is gonna be there's a fund that people put up the money, and then they go listed, somewhat like semi-listed, and then on the exchange. And then after that, they decide which company they're gonna buy, and that company after get acquired by that fund is getting on the exchange through the SPAC process. Is that something that I understand it correctly?
Yeah, I mean, you're pretty close. That was a pretty good summation. At the end of the day, you have these public shell companies that you raise an IPO for this. It's on the public markets. Like I created one where I chose the ticker to be CTAQ. And now that's the ticker on New York Stock Exchange or on the NASDAQ. And CTAQ raises funds and then it lists on the stock exchange, and it has a window of time at which it has to find a target. Once it finds that target, it acquires that target, and through a de-SPAC process, that target then becomes public and like removes that shell of that company. But it's all theoretically a merger. So investment bankers don't necessarily have to underwrite the company in the same way that they would through a typical public IPO process. It's the company, the sponsor SPAC company that underwrites the company. And then it goes to a vote, and then that's how the acquisition process happens. And then it's on the market.
You mentioned about the retail investors, and obviously after the SPAC frenzy, there were a lot of headlines about how retail investors were kind of being taken advantage of a little bit. So what do you think about like the retail investors that were buying into this SPAC? Were they aware of the risk that they were buying into, or was it because like everybody around them was making money, like I guess psychologically trigger this FOMO feeling that, okay, I gotta get into this area before I get died down. So you actually, being in the area, being in the trenches, I want to hear what was, the conversation inside the boardroom at the time about sophisticated investor versus retail investors for these SPAC vehicles.
Yeah, so the vehicles, honestly, the only people that made money were the sponsors, and I would say institutional investors that were brought in at the time of the IPO of the SPAC by the bankers, because they're the only ones that really see the pricing mechanism, and they see that, bump that happens with regular IPOs too. And it's kind of the same thing. And so I do remember when I was in the meat of it, like in the thick of it all, I told all my family and friends, do not invest in SPACs. Don't touch it as a retail investor. Like, do not. I think there was obviously a lot of hype and people wanted to be involved in a way that, they weren't able to be involved in the before, but it's the same thing as any, company that IPOs. Like the retail investors, a few maybe get a part of the jump, but there's no way you're going to get the whole thing. That's going to go to only the institutional investors that come in before you even see any of it. So I don't think any of that changes with SPACs. If anything, you have less information because you don't know who they're going to acquire.
I'm like curious. I just recently like got exposure to like public equity or public company related transactions. And I work in the green tech space, and obviously a lot of green tech companies like batteries or like, metal minings for the batteries industries. A lot of those also like went public through the de-SPAC process in 2021. A lot of them are like trading under, like they clearly show an unclear path to like cash flow break even. Like some can be 8 years from cash flow break even. I just wonder, like, with the current environment, like how do you see, would be like the typical or like most common route for like exit these companies that are doing poorly in the public, because they clearly shouldn't be public, I feel like. And yeah, like, I mean, we pitch on a couple of tech privates, but some of them are still raising money through like secondary offerings and stuff like that. I don't know what could be like the most common and viable routes for these companies that went public and then now doing poorly in the green tech space, at least.
Yeah. So in my role now as a VC, I invest in the energy transition. So I see a lot of these companies and I see these dynamics, and you're totally right in the fact that some of these companies should never have gone public in the first place, but they probably knew that, which is why they went through a SPAC and not through a traditional route. What that did really was shift the risk profile and the risk tolerance from venture to retail and public investors, which actually have a way lower tolerance for any type of misperformance. At least with venture, people understand, they're going to be, not revenue generating for a while. They understand that this is a long-term bet. Retail and public investors, like, they don't have those same timelines. Well, at least the majority don't. And so they're under so much more scrutiny. In terms of an exit, I do think that one, you can try and potentially do a take private. That's obviously like a situation, but the appetite again is tough because the strategics that are potentially looking to acquire these companies or take them private, it's often private equity or growth equity, and you have to have certain metrics for that to be attractive for them, which again, these are not there, or else, they had gone the traditional route before a SPAC, they would still be in early stage venture. They wouldn't be in the growth stage. And so private equity firms don't really look at these as normal targets. And so I think they're going to be middling for a while until maybe they delist. You've seen plenty of de-SPACed companies just go bankrupt, and that's happened, and it's just a reality. Theoretically, if they continue to perform but just like are not up to public standards, I think there is like a strategic play for some of them, especially I would say in the green tech space, because there's a part of that where certain strategics, and especially corporates in like utility, energy, they're able to take advantage of the technology and not necessarily like the go-to-market or the traction so far, but the intrinsic technology, and they're willing to potentially acquire for that. But that's not always the case for every single one of them.
Yeah, no, that makes sense. I think like in terms of like strategic acquirer, what I observed, like interesting, I was on like a vertical farming deal, and it's interesting because when it comes to like strategic acquirer, for example, like in the vertical farming space, yeah, like it can be ag incumbents, but like a lot of the time, given the risk profile of these companies, I've seen, recommendations or like potential routes also being like fellow vertical farming companies acquiring each other. I personally didn't understand the math around it, like all these small companies, but I think it can make sense in terms of like they consolidate into a big platform because all of them like are into this like new emerging technology space. Potentially can become like a package or like consolidated platform to be then acquired by like a big incumbent instead of like just bolt on like acquisitions. But that was what I observed.
Are not going to work, especially when the market cap is so small. Like it's not even worth it for them.
I think for like I had a conversation with a friend in growth equity, and she was also like considering there's a lot of advice for young people like us to like, before going into venture or growth equity to do kind of buyout first or working on like, post profitability companies to get some kind of exposure to fundamentals before like, because I think when you do venture, it's a lot more about like, understanding the story of the company and seeing the growth vision. So do you think the growth equity or early stage venture skill sets versus like the buyout skill sets, if you know for sure you want to do growth equity, should you just go straight into it, or should you like try to also get exposure to some kind of post profitability company first, like buyout, private equity buyout, before you transition into that space?
That's a really good question. Somehow I've done all three in my career, but I think the skill sets are so different, to be honest. And I think you as a person will find what you prefer most. I actually think going from growth equity to venture was a lot harder of a transition than I think venture would have been to growth, because when you're in growth and you're in buyout, you are used to a certain profile of a company that has real metrics that you can measure, that you can do math around, that like makes sense. In venture, you don't get that. It's just a totally different evaluation of a company. I remember when I went from mostly growth into venture, and I just could not believe the multiples. I was like, wait, what? We're underwriting what? We're underwriting a growth rate of a couple 100%? Like, this is crazy. Versus if you go the other way around, like all of a sudden, like you could really love a company and then you see their metrics and they actually are profitable and cash flowing. You're like, this is a home run. Like, yeah, let's do it. Versus the other way around, I think that's just, it's much harder to wrap your head around early stage pre-revenue companies when you've had the experience of seeing companies that are very well funded and cash flowing and have, you know, cash on cash and metrics that make a lot of sense and are very stable. Then to go down to venture, you kind of have to kind of throw that out the window. It's a very different evaluation. You're thinking about team, you're thinking about market, you're thinking about revolutionary technology that doesn't exist, a market that doesn't exist. Like, you're creating a market and instead of like capturing one. I think it's very different. And so I would actually say, you know, if you want to do venture, you should do venture. There are other ways of doing venture than going through buyout or growth. I think working at a startup, I think doing research, I think trying to be a founder yourself. Like, there's so many different ways that you can bring that skill set to venture. I think there's a very prescriptive way to get to growth equity or private equity, and that's probably just through doing investment banking, consulting, or modeling tests. But I do think that they are very different skill sets.
I think to level set our audience, a lot of them may not know about the investing space. Vanessa, can you just walk us through the different styles of investing, like from early stage to late stage, and what are the differences in skill set, pros and cons of each?
Yeah, no, I'm happy to. I think part of the reason that I have experience at all of them is because I was trying to decide which one I liked best. And I think it really depends on the person and the way you like to work and what you like to work on. So early stage, which is what I do now, is there are multiple different stages of early stage investing. There's pre-seed, or actually before that, even before that, angel, friends and family, which is literally like you ask the friends that you know on this call, like, hey, give me money, I have this idea. And so it could be someone as simple as having an idea, and it's called angel because these are your, you know, they're coming out of nowhere. They kind of have to have faith in you and just say, yeah, I believe in you, and they'll give you money to start your idea. And it's usually just friends and family. Beyond that, you get to pre-seed, which is typically, I would say, a little bit more baked than idea, but not that much more. You have to know the problem you're solving, the solution that you have. You may not be developed any revenue yet or even any customers, but you know, you have a really great mapping of where you're going to attack for your go-to-market. You know what your product solves and why you are the one to do it. And you've hopefully at least gotten some initial traction, whether that's a pilot, whether that's just interests and quantitative interest, whether that's surveys, willingness to buy, all those different things. Then you get to seed. Seed, you typically have recurring revenue. You are probably just on your first or couple customers, but you have some recurring revenue, hopefully, on a monthly basis. And depending on your business model, of course, but hopefully some revenue that is showing your traction and that people want to buy your product. Typically, these days, rounds are moving around, but seed can be like $1 million of revenue, maybe, sometimes. Then you get to A, and A is where I invest right now. It means that you have revenue. Hopefully, you have more than one customer. You are doing some amount of, if you're doing software, some amount of recurring revenue. If you're not, you at least have like around, I would say, a couple $1 million of revenue, hopefully coming at you at the end of the year or next year. And you see a path to that. You're still not anywhere close to profitable, but you're at least making some revenue. And you have had some sort of institutional investor at the seed or the pre-seed. Series B, it gets serious. And this is probably the hardest stage at the market right now. People are struggling to get to Series B because that's when right now, as rates are higher, cost of capital is higher, like people are looking for profitability. People are still looking for, if not current profitability, a road to profitability. Like one day you'll have the sustainable business model here, and you're looking at hopefully 5 to 10 million of revenue. That would be great. Beyond that, Series C, now it starts being like, you're profitable, you have EBITDA, you have at least like $15-20 million of revenue. That's cool. This is where growth stage investing comes in, growth equity. And oftentimes with growth equity, it's so much more about just accelerating growth. That's why it's called that. It's not as much about figuring out if there's product market fit. It's not as much about, where's our market? It's about, okay, we know we have product market fit. We're just looking for go-to-market and accelerating our go-to-market efficiency. We're accelerating, retention for our customers. We're just going, and we need capital infusion to grow as fast as we can and sustainably, hopefully at that point. D and E, sometimes people don't even get to D and E, but like D and E is the later growth stage where you're hopefully doing hundreds of millions of dollars of revenue and 50 to 100 millions of dollars of revenue. And this is where private equity starts getting interested because you have a sustainable business model that hopefully is also providing some sort of EBITDA or cash as well. And you're either looking at a strategic exit or an IPO. And then you get to IPO and there's public equity investing. And also in between there, if you have an awesome business model, you're getting cash, you're profitable, your growth rates have gone down, but you're a great business, that's when private equity gets involved. And private equity does often leveraged buyout, where they are able to use debt to lever their equity to purchase your whole company or a majority stake of an ownership stake of your company. And that's where they feel like these are companies that they can own, they can take ownership of, and they actually might be able to run better sometimes. And oftentimes there's more of a roll-up or consolidation or platform play with some of these buyouts. But those are long-term holders. Those are people that are like, we love this business and we want to probably own it forever. If not, maybe have it go public at some point, but probably own it forever.
There's a question that I think there's a lot of people who already asked you before, such as the question about like what skill, gonna be fit for each stage of investing. Mm-hmm. But I think I will just focus on one or two stages of investing, either growth, equity, and venture capital. I will start with the growth equity first. With soft skill and especially the technical skill that the growth equity investor is gonna need, especially with the people starting young and they just, let's say, start their career like 2 years to 5 years. What skill that they should focus in developing though?
I would say growth equity, you're looking at financial engineering. So you really do have to know your financial statements. You really have to know your modeling. You honestly have to understand about the public markets. A lot of times the valuations that you're doing are based off of public market comps, so that this company in the future, when it exits, hopefully by public, will be using comparables. And so not only are you being able to take any type of financial statement that a company is giving you and then run scenario analysis on it of different growth profiles or different growth scenarios, then you're able to put together a valuation analysis based off of a number of things that could happen to that company. But you are being able to model that out. You're being able to say, if this company makes this acquisition, this is what's going to happen. If this company increases the prices on or pricing model or changes the pricing model on this particular product, this is how it's going to happen. This is how revenue is going to grow. This is how it's going to affect the valuation. And so we think this is our thesis. This is why we're going to invest in it. And being able to think through scenarios like that. There is a bit of financial engineering there. But really, I would say really in-depth industry knowledge. I think at this point in growth equity, a lot of times growth equity shops for the most part are pretty vertical specific. You're like, I'm doing healthcare, or I'm doing B2B software, or I'm doing consumer. but you're pretty honed in on a specific, there aren't, even within generalist shops like TA or Summit, they have specific teams that everyone kind of is on. And so I think when you get to growth, so much about it is how do you capture market share? How do you comp up between other competitors? How do you expand your go-to-market? And do you have a view on that? Do you have a market and industry view on that? And can you run different scenarios for those different market industry views? This is very different in venture. Venture capital, especially at the early stage, you are just meeting a ton of founders. Most of you, it's their first time building a company. And so you are doing a lot more of an assessment on team. You're thinking about team, you're thinking about technology. So you're oftentimes are trying to suss out like the viability of a technology and whether or not this is something that is really transformational, could have a moat, could have a really big market. But it's definitely very, very limited on the financial engineering. I used to be in spreadsheets all the time. Now I sometimes run a return analysis, but it's kind of shaky. Let's just say I'm on a Mac now, and I used to be on a PC. And so that's a big difference. And so a lot of what
That's funny.
You're laughing, but it's true.
That's funny, yeah. I mean, no, that's one's funny.
But yeah, I mean, I spend most of my days looking at pitch decks, which is on, a PowerPoint. And then I spend a lot of my days on PitchBook. I spend a lot of my days in meetings with other investors, trading deals, talking about founders that we know. And I think a lot of time, what we do in venture is really doing deep dives in specific. So I think research is actually a bigger component of early stage venture. I think it's not as big of a component in growth stage because to a certain extent, like I said, it's industry trends. It's kind of a singular company that you're kind of comping against. Whereas in venture, you can make multiple bets in the same market or the same industry, but you have to have a view. You have to have a very specific view on a specific type of technology or a specific thesis on something that may or may not even be, in use today. And you have to run that down and you have to see who are the market mapped leaders in this area and are they the ones that you want to be investing in? Do they fit like your firm's strategic and financial criteria? Do they fit your thesis? And so I do think there's a bit more of research because you're also constantly trying to uncover new people and new companies and new technology. So you're doing a lot more digging. There's so many companies out there at the early stage. There's so many founders. There's so many funds. And so your pool is just so much bigger. And that's why at the early stage, a lot of your time is spent sourcing. It's just talking to a bunch of people, trying to meet this guy who used to be an engineer at some tech company who's now building this company that your other friend told you about that could be really big because of XYZ. So it's just like you're weaving together stories. You are putting together different networks. It's a fundamentally very different way to invest.
For sure. Yeah, I have a follow-up question on venture investing. It sounds like it's a combination of a lot of different skill more than just financial engineering. Because in the early stage, even if you want to model our business, you can't because there's not much of the number. So it's one thing I noticed in the venture capital market and different venture capitalists, they have different style to play in the game. So some people is going to be more strong about the financial engineering, about the later stage. Some people is stronger on the people skills so they can source a lot of deal. A lot of people, they do a lot of research and they have strong view and deep understanding about technology and idea, so they can really think through and have a very clear view idea what technology might work and might not work.
Yeah.
And one question that a lot of people, even like myself, asking when it comes to trying out venture investing as a young people is a few venture capitalists, they say the operating skill and knowledge is very important in venture investing. It's not just about researching and understand about the idea. And there's one way that people should spend their time and joining startup, joining, the company to learn about operatings.
Yeah.
Another camp is really say like, oh, in the young stage, you also should focusing on developing the somewhat general knowledge to be, stronger, more solid generalist and understand and really have stronger view so that you can figure out who to talk to and what idea that you should focusing on. So which one do you think is more important? Is either commercial knowledge and fundamental understanding about the idea or operating skill and knowledge?
I think the operating skill set is much more important at the venture level and much more highly valued. I think part of that is because honestly, like I started a startup and I've been at a startup, both of which failed, but I have so much more founder empathy and I have a much better understanding of like the actual inner workings of how does a go-to-market strategy execute and happen and figuring out ICP and partnership and commercial economics because of that. And those are all skills that you really need when you talk to founders, when you're guiding companies at the early stage. The commercial knowledge, the industry knowledge, that's much more helpful at the growth stage.
So you been through a lot of different roles in investing. So like what excites you about Series A investing that you are currently in right now, and why did you choose it?
So what excites me about my current stage of investing is honestly my favorite part from the day I started doing private equity till today has always been meeting management teams and founders. It's always been that. For me, it's so much more about getting into these meetings, talking to them about their priorities and working like shoulder to shoulder with them and saying like, okay, you want to get from A to B, how do we get you there? And that's always been like the most fun part for me. And I do that a lot more at the early stage. And then where I am specifically right now is really exciting because I'm investing in the energy transition. And that's a really cool place to be right now. The technology is evolving so quickly. And honestly, I'm a relative newcomer. I did B2B software. I did fintech. I did not do energy. I did not do mobility. I didn't do transport, all of these things. But because it's moving so fast, I don't even feel like I'm behind because everyone's behind all the time. There's so much new technology that's coming out every other week. And it's just also highly relevant to the world around us today. And people will talk to me about, do we have the energy capacity across our utilities and our grid? People will talk to me about the adoption of electric vehicles. People will talk to me about permitting and transmission. And that's all really relevant to everyone's day to day. And so it's so much closer to home than honestly, like I think AI is really interesting and B2B software, love B2B software, but it's definitely not the most fun thing to talk about to be like, oh yeah, well I invested in this, data compliance software the other day that's, helps augment the Microsoft 365 ecosystem. And it's like, okay, well, so I love those models. I actually really, really love, and same as developer tools, I think it's really one of my favorite things to dive deep on. But I'm glad that I'm able to actually apply those things to this new industry and I'm learning a ton.
Let's shift gears a little bit. Let's talk about, women in finance, D and I. Obviously, in Asian, also a woman in, the world of finance, which is predominantly white or, male,
Yeah.
right? So how has your experience been like, being in that world, going back all the way to the beginning of your career at PIMCO? You say you were the first social, was it challenging and then navigating through the world of startup these days, venture capital, meeting with a ton of entrepreneurs, founders.
Yeah.
Do you still feel imposter syndrome when I'm sure even for male venture capitalists, they still feel that. But we'd love to hear more about your personal perspective alongside that journey.
Thanks for asking, because I do think it's something that I, one, don't appreciate as much as I should. And then two, I think people should talk more about. When I first started at PIMCO, it was extremely difficult. I was the only female on my team, especially in headquarters. I think there was another female eventually in the New York office, but I was in headquarters in California. And I was the first associate, so I was already isolated, but then I was the only woman. And to be in a boardroom of all men and be the only woman and be the most junior person in the room is extremely difficult. To be honest, it kind of broke me. After 2 years, it became very clear that I put a ton of pressure on myself to overperform, and I wasn't able to say no. I was never able to stand up for myself. I was never able to say no. There were plenty of instances that I look back now that I can see a little bit more clearly, that I'm like, whoa, I can't believe I just let that happen to me. But it really was especially for like an asset management firm that has so much money and has so much power and so much control, I think it really makes you feel like, oh, you're just so lucky to be there. And there's nothing you would do to potentially put that at risk. Because my whole team was also men, like they had poker nights, they played basketball together, they did all these things, and they never invited me. And I think I just kind of like was like, yeah, that's normal. Like, what?
No,
but now I look back and I'm like, that's not normal. That's not normal. And I never really stood up for myself back then. And I think after a while, it actually took, so I mentioned I like passed away at some point. I remember that vividly because I had a really tough time with that, but I felt like I couldn't cry. I felt like I couldn't tell anyone about it. I felt bad even going back for the funeral to see my family. And my family's such a big part of my life. And I was so far away. I was out in Newport Beach, California, and none of my family was around. I had some family in Orange County, but I didn't have time to go up there. I worked like 7 days a week, every day. Like it was just constant. And part of that is also that I was the only associate. So it's not like when you're in banking and you have an analyst class or a class that you go in with. I was teaching myself everything. And I didn't feel like I could ask for help because then I would look weak. So it was a lot of self-learning. It was a lot of YouTube videos to understand how to better, faster model. It was a lot of just trying to do things and make it look like I knew what I was doing without actually admitting that I didn't, because I just didn't want to look like I was any weaker than I was. And I think after a couple of years of that and finally finding some mentors at the company that weren't necessarily in my group, but, other women, other folks my age, I realized that none of that was normal. None of that was healthy. And that's part of the reason that I ended up going to the IFC, going somewhere closer to home and understanding that, like, I did have the privilege of working at this fund, and I learned a ton in my 2 years there, whether it was on my own or from others. How do I use that to leverage myself getting into a better situation and in a place that I actually wanted to be, doing something that I felt very passionate about? And that's why I got to the IFC. I was looking for a place where I could make an impact, use the fundamentals that I had learned in investing at a very high caliber fund, and actually do it with the intention of impact and somewhere close to home so I could see my family.
Yeah, that's really great. And I think I personally relate a lot in terms of I'm lucky because I have a really great analyst class, but I think power and infra is just a very male dominated place. And whether in banking or transitioning into PE, like infra and power PE are also very male dominated. And so I think, my fellow, female analyst, she's actually also Asian analyst, we have been, debating a lot of the time. We love the green tech and just, infra space, but whether to kind of, firstly, infra it's like a segment that just work a lot of hours. Like it's known to be pretty sweaty and difficult and very technical driven. On top of that is the culture. And I think the question, I don't know if this is going to be a question, it's more like a discussion, but at what point do we kind of compromise our mental health and, just the sense of it's not just sanity, it's just, the feeling of being appreciated for our work and not just, feeling belittled for just looking different or not belong to the kind of fratty culture of the space. At what point do we compromise or choose between following our passion and continue and continue working in the space, or if it gets to our mental health, then do we kind of find like an exit to like a better culture and a better space? We found ourselves constantly kind of choosing between like learning opportunity and growing infra versus like working in a sector that's a little bit more female friendly or minority people friendly. And that was like my personal experience as well.
Yeah, no, and even my parents, they're immigrants. They're very focused on like making sure we have the best careers. And when I landed at PIMCO, they were like, "Oh my God, amazing. Like you're at PIMCO, like stay there forever. You're in Newport Beach, Orange County, like stay there forever." And I was just like, "No, guys, like I'm struggling. My mental health is an issue. Like I don't feel happy. Like I have to leave." And it was hard for them to understand that, to be honest. I'm sure there are other people who saw my position as, the sole associate for Bravo, PIMCO's only private equity fund, and was like, wow, like that's amazing. And when I stepped away to go to the IFC, which I think some people thought like that's a step down. You're going to the World Bank, like that's a step down. But I had to get over that because I was like, I'm choosing myself and the longevity of my career versus staying here, which is theoretically the most prestigious and this really amazing opportunity, when I knew that it was just completely toxic. And I had to think about, can I do this? Can I turn this into something that, will ensure that I'm still learning a lot. I'm still at a place that people recognize. It's not like the World Bank is like the worst place to be. It's still like a pretty cool place to invest. And I had to like also say like it's okay to step away and find something that aligns with my values, because it was really tough. It's really, I think you always have that question of like, this is the more prestigious group. This is what everyone sees as like the thing to do. And then it's what's actually your feeling and your ability to say, no, I'm standing up for myself and what I know I need. And at the end of the day, like that was in 2014. This is 10 years later, and a venture investor now at another company, and I'm perfectly happy with my life. So it's like, you never know. You have so many different paths to the ultimate career that you will have. And I think when we're younger, it's hard for you to see beyond just what's immediately in front of you. But that was my first step towards saying like, no, I'm going to choose me. I'm going to do it the way that I want to do it. I don't have to subscribe. There's not just one way to have this type of finance career or a really good finance career. And by the time I got to HBS, I thought, I kind of took a step back, and I was doing IFC, but like HBS still thought that was cool. Like it's fine. And then when I went to these other funds and my jobs beyond that, I think it was just understanding that like I made choices for me, and that still worked out. And that's still like, I still have a successful career in finance, and that can look so many different ways.
Have a follow-up on that before I guess we talk about your HPS experience. I mean, you were at PIMCO, absolutely. I'm sure that your parent was very proud of you. And looking across your, other experiences, it seems to me your average tenure is like about a year and a half or 2 years in each place. So I guess after that hard experience of leaving PIMCO, you've gotten a lot better of moving or changing workplace, right? Which is something that I feel like the older generation, they're not comfortable doing, like taking risks, stepping out your comfort zone. So I want to hear you talk more about that. What was your feeling like? I know like leaving a team is not easy. Well, maybe PIMCO, you don't have a class of analysts, like you said, right? But maybe for other firms, you have an investment team, you have other people, maybe you have some bonding experience. So what's your advice for people who are thinking about changing jobs or changing companies or still like hesitating, so on and so forth?
Yeah, no, a big part of it is, in a way that a framework that I use is look at the people who are not one or even two, positions above you, but like 3 positions above you. And is that the person you want to be? Is that the role that you want to have? And if that answer is no, then you shouldn't be spending your time there. You should be in a place where if you do spend the time and you do invest that time, which is precious. it goes by so quickly, and these are like the key times of your career right now. And if you don't see yourself in those shoes, like, you shouldn't be there. Every single day that you invest in the relationships at that company and the skills for that role, like, it should be going somewhere. And for me, I think PIMCO, that was like, certainly I looked at my MDs and I was like, they look like they are overworked and lonely, and I don't want to be those people. So I'm going to go. IFC was a little bit different because almost everyone at IFC after a couple of years goes to an MBA. So that was like a little bit of a path. But then I also was like, the senior investment officers, like, do they look happy? Not really. I think I would come back to the IFC when I could be one of the, I forget what they are right after senior, but like, they're in their 50s and they just travel and they just don't work that much. But so when I retire, I want to go back to the IFC. But then similarly, when I was at Explorer, especially with the SPAC thing, I was like, do I just want to be doing SPACs forever? Probably not. I really like the technology investment that we're doing. So let me go find somewhere else where I can do more of that. And for Twilio, I actually really loved Twilio and I loved my team there. But that was a situation where at Ampla, they actually gave me the opportunity to be a director and lead a go-to-market for a startup. And I'd never done a real operating role before. And I was like, you know what? I've always thought about it. I've always thought, like, what if I did a startup? What if I was on the operating side? And that was my chance. And it got me back to New York. So it was a bigger thing. And then with Ampla, I was like, this company, I don't want to be at this company in a couple of years. So I left. So I think it's a little bit of just constantly checking yourself, constantly being like, is this getting me to where I want to be, the person, and also the person that I want to be? And does this company have the longevity that I think I want it to have? All of those things. And really making sure that you're constantly on that path and you're not just there because, like, it is just a stepping stone. Like, that's not really how you should view it. Every job that you take, you're spending so much time at that job. Like, you're spending more hours than you do with your family at that job. The things that you're learning every day, the type of person that you're becoming is shaped by that job. So if you don't want to be there long term, like, you shouldn't be there.
Yeah, so I have a follow-up questions about HBS, since you mentioned about the HBS. Yeah. How different it was from the interaction at work and, at home or with your friends before and after you go to the HBS. And also, like, it was any less stress after you go to the HBS and get recognized? The stress from, social status, from the respect from others, and also how people treat you. Was any difference in the way that people treat you at work? Especially, like, as you expressed before, you was really junior in the team, also the only woman in the team, and you feel like it wasn't okay back then. So was that any different, or was that any better after you go to the HBS and earn the respect from a lot of people?
Yeah. So there were a lot of questions in there, but in terms of the way that people thought of me before or after HBS, I don't think that changed that much, to be honest. I think I thought of myself differently before and after HBS. I think I gave myself a break. And part of that is because one of the beauties about HBS, and they tell you this, they kind of sell you on this. They're like, after HBS, you will never be wanting for a job ever again. Like, you're always going to get it. It might not be the one you want. It might not be something you like, but you'll always be able to get a job. And so I think that just automatically takes pressure off. Whether that's, you're just going to be like, oh, I'm a sales executive for a company, or I'm just going to, be a financial analyst for a company or something. Like, you're always going to have a job for a certain amount of salary that's pretty good. And so that's really just reassuring in life and allows you to have a lot of flexibility and creativity with how you want to live your life, and allows you the freedom to pursue what you actually want to do, because you're like, there's this safety net that comes with HBS that there will always be something there to break my fall, because not only do you have, like, the HBS degree, you also have the HBS network. You have this whole new embedded friend group that is like, yeah, sure, like, there's an opening at my job, at my company, you should apply for it. And even if it's not, like, something you want, you probably have a chance. So I think that is very freeing about HBS. And people ask me all the time about like whether it affected my future roles. To be honest, my current role, they didn't affect it in like an immediate way. And actually, I would say business school in general, the jobs I got after business school, I probably could have gotten without going to business school, like the growth equity, and like those are things I could have done with my experience beforehand. But it really comes in later. And I found that with this most recent role at WEX, because it just so happened that the guy on the strategy team at WEX that launched the fund, he was like a classmate of mine at HBS. We weren't like friends, we weren't in the same section, but we graduated the same year. He actually lived next to my now husband in the same like dorm building. And so we just had all these little ties. So when he announced that, you know, he just started this fund at WEX and we connected, and he picked my brain about my Twilio experience, and we just had this natural rapport because we were like, oh yeah, and you knew so-and-so, and like, and even in our team meetings today, we reference HBS cases because we took the same classes and things like that. And so you have this level setting, and I would not have gotten this job. I mean, maybe I would have because of my experience, but I was a shoo-in for this job because I went to school with this guy.
To take a step back about the education, one thing that I found great about you, you also attended a very prestigious institution as an undergrad as well. And I know all Vietnamese people, like, we value education so highly. So maybe first, like, how's your experience growing up that shaped you to be able to attend those institutions as an advice to our audience for both your undergrad and your MBA?
Yeah, well, I mean, the DC area in general is like Montgomery County public schools. I went to public school, and Montgomery County public schools are a great public school system, and a lot of people from this area are very high achieving. And my parents, you know, chose this school system when they moved here for a reason. And so that's certainly part of it. But then I honestly had no idea and nor desire really to go to an Ivy League school. My parents told me, you can either go to a state school or you can go to an Ivy League school, because either way they'll pay for it. Like, that's the only, my parents really couldn't afford it. So like, if you go to a state school, it's really cheap. If you go to an Ivy League school, you'll get financial aid. So those are like your options. And that, or like California, because they really wanted me to move to California. So they had me apply to UC. But I applied to like 15 schools, everything from like Boston College to like UVA to UNC. I had 100% thought that I was going to go to Maryland, which is my state school, because all my friends were going there. But Dartmouth was just kind of like, well, I don't want to say it's random because I obviously worked hard, but I didn't have the best grades in high school. I didn't necessarily have the best test scores, but I did a ton of extracurriculars. I was in the county student government. I was in the state student government. I did the, obviously, school student government. I did club soccer. I did swimming. I did American Cancer Society. It's just a ton of stuff. And I definitely think that's why I got into this school, not because my grades were the best. I spoke about my Vietnamese traditions in my essay, and about how, you know, we start every meal at home with Muc and Ya every single day. And that was my essay. And I think, you know, just being very honest and very true to who you are. And I still interview for students at Dartmouth. I'm part of, you know, the alumni group that interviews for Dartmouth students. And it's so much more compelling when they have an actual story about who they are as a person and what makes them extraordinary, rather than like, oh, you know, I got straight A's, I'm doing this research project for this senator, and, you know, I also doing all these things that are very obvious because I want to get into this college. And so I think that's part of it. I think my parents were actually, unlike my brother and sister, I'm a middle child. I have an older sister and I have a younger brother. They were very on top of it for both of them. They kind of let me do my own thing. They're kind of like, maybe it's a middle child thing, I don't know, but they're like, apply to the schools that you want to, but like, again, we can't afford much. So like, you either go to one of these two. And I was fine with that. I was like, you know what, if I go to state school, I go to state school. I was still going to be in the honors program. Like, that's fine. And I actually found it somewhat challenging when I went to Dartmouth, and I didn't really know what I was getting myself into, because at Dartmouth, there were so many people from like New England boarding schools and private schools I'd never heard of. And it was really hard too. I went to a public school, and no one in my family had ever gone to an Ivy League school. No one in my extended family, none of my cousins had ever gone to an Ivy League school. And so I think it really started to open my eyes, but it did allow me to think of myself and open myself to opportunities that I would say my siblings didn't necessarily have. The fact even that I went to intern at PIMCO, like I didn't even know what finance was before that. Like I had no idea. I didn't know what a bond was. And it's just the fact that, Dartmouth, they have these programs where recruiters come and, there's like these cohort, this is what you do. And I wouldn't have known to do that or be in any of these things without being at Dartmouth. And so I think I was very open. I was very realistic. I thought I was going to Maryland until I wasn't. And then similar to actually HBS, I actually had gotten into London Business School, and I was so excited to go to London Business School. I really did. I put down a $10,000 deposit that I'll never get back because I thought I was going to London Business School. And after I got into London Business School, my parents were like, really? Like, you have to go to Europe? Why don't you stay nearby? Like, why don't you go to school in America? And they're like, you already got into London Business School. You can go if you want, but just apply to HBS. Who knows? And I applied to HBS and I got in. So I thought I was going to London Business School, and it occurred that I got into HBS, but I didn't necessarily model my whole life into getting into HBS. Similar to Dartmouth, I didn't model my whole life to get into Dartmouth, but, I think I was very realistic about I'd be happy with all this set of possibilities, but I'm still going to reach for something awesome. And if it happens, it happens. I'm not going to model my whole life around that. And I think it makes it sweeter, honestly, because I just feel very grateful, and I don't feel like I was entitled to any of that.
I feel like your life story is a perfect example for Steve Jobs' quote. He was talking about you cannot connect the dots looking forward, but you can only connect the dots looking, backward in hindsight. So yeah, you didn't choose Dartmouth or, HBS or all of that, but right now you're in a good spot and, doing the job that you like, having a good time with it. So I guess that's a takeaway for me, and maybe for all the young professional listening to this podcast too. If you're doing something and kind of not knowing where you're going, just keep pushing hard, and then just, hope that the future is always brighter, I guess.
Honestly, a big part of, I think, where I get my confidence to go in whatever direction is I'm super happy with the person that I am and everything that led me here, whether that's, where I grew up, what my parents did, the sports I did, the clubs I joined, the classes I took. I wouldn't change any of it because I genuinely think I'm a great person today. And I think that gives me a lot of confidence because, none of that, again, like you said, I specifically wrote out in my master plan, but all of those components, good and bad, made me into the person that I am today. And I feel very lucky for that. So.
And Vu is the one most passionate about MBA in our podcast. So do you have any question about if MBA is worth it or expensive for Vanessa?
Yeah, sure. I think there are a couple of questions about MBA. I think maybe related to investing. One thing I saw that is that sometimes you go into a pre-MBA program for investing and then they kick you out and then you do an MBA and then you come back. So do you think like an MBA actually helps for investors, both from credential and skill and networking perspective? And have you seen like successful investors without MBA, I guess? That's the first question.
Yes, I've seen awesome investors that never went to business school. I've also seen awesome investors that have, and I don't think it really makes a huge difference. I do think that the ones that didn't go to business school, they spent their time often at really cool companies, especially venture. A lot of the ones that I know that didn't get their MBA, it's because they spent, 10 years at Uber, or Google on the product management team a couple years, or Apple for a big part of their career. So I think the MBA is a really great way to say, I kind of know what I'm doing when it comes to a business. But you can also do that by actually like knowing what you're doing at a business and being part of a company for a while and being like, yeah, I've gotten a ton of operating experience. I know how a business runs. That's just as, if not much more impressive, I think, for an investor. I would say MBA is really good, like similar for me to figuring out what type of investing you want to do. There's so many different types of investing, and MBA is a great place to try things out. So if you're like unsure, if you're like, oh, I kind of think I want to do private equity, but I don't really know, like MBA is a great time to go and then do a private equity internship and be part of the private equity club and learn a ton about it. And then at the end of it, you can either say like, based on everything I've learned, not really for me, I kind of want to go back to doing operating or something else. But it also, during MBA, you can do venture internships that are like during the year, and you can do a part-time thing. And it's just when you're working, you just don't have time to explore. And I think MBA is a really great time to just explore. So I wouldn't necessarily say an MBA is a prerequisite for investing. Actually, it's probably one of the few jobs where I would say that isn't true. Like I would say in a lot of corporates and consulting, like it is kind of a prerequisite. Like you kind of need that to go up. But I don't think that's the case in investing, actually.
Move on to some quick fire questions about your personal hobby before we wrap up the podcast. I guess I can start with one. If you're not doing investing right now, if you had all the money in the world, let's say you made it already, what would you be doing now? Where would you be? I guess you would still be in DC to be close to family, but yeah, what's your other profession, I would say, that would be pursuing right now besides investing?
So my family has always really been involved in real estate. So I also love real estate. I've bought and sold a couple of different properties. I have another property. Over time, I would love to do that, just have a big enough portfolio where I'm just doing that. And I feel very blessed because growing up, honestly, like my mom's family, even in Saigon and in Vietnam, had a lot of properties before the war and stuff. And so like, it's just been in my family for a really long time. And my mom is a part-time real estate agent, even in retirement. And she was very passionate about each of us owning a property, even at a young age. My younger brother is 27, 28, and he has a property to his name that we helped him purchase, but at least now he has an asset. And she was really passionate about that. And maybe that's formed by kind of their experience in Vietnam and property ownership and all of that. But it's something I really enjoy doing. And my husband knows that I send him Zillows all the time of like, this is a great place. We should look at this. We should look at that. We should look at that. And to be fair, my first job at PIMCO was a real estate like we did some commercial real estate transactions. So I learned a lot on the institutional side, but then even as like an individual, I love it. And so hopefully I can do that one day.
Great. Well, that's felt like a cheat answer because still investing related, but anyway, I'll take that.
Another one that I do also on the side as a side gig, I'm also I have a side gig as a travel advisor. So I do that.
Interesting. If I have $1,000 saved up, where should I
what's
go?
What's your most favorite place to travel?
Yeah.
As a travel advisor.
I'm a little biased. I got married in Italy, so I loved Italy, and I will always love Italy.
So Italy? Which part of Italy? What city?
My aunt and uncle have a house in the countryside in Umbria, which is like a central province in between Rome and Florence, and it's like a tiny village. No one speaks English there, but it's like one of my favorite places. It's right in the countryside, and it's just so peaceful, and the food is amazing, and there's no Wi-Fi, and that's awesome.
Well, I think one fast question is, would you consider retiring in Vietnam?
Someone mentioned that to me recently. So I'm bringing my husband to Vietnam for the first time, his first time, in April of next year. So we're really excited about that. And I've been many, many times, but I think I've heard, like, just as much as like potentially having a house in Europe is great to, like, you know, travel all around Europe and use that as a base. Vietnam could also be like that for Asia. And so have certainly thought about that. But if you guys have any, you've probably been there more recently than I have. If you have any recommendations for me to sell my husband on it when we go in April, please send them my way.
I have a list. I have
Yes,
I have a list. I sent to Anvu recently, so I send it your way.
If someone asks you to be the author of a book right now, like, what would you write? Can be fiction too. I know you read a lot of nonfiction, but
funny you say that, because when I was younger, probably like when I was in high school, college, I actually did try and like write a book. I called it Life Lessons with Cupcakes. And it was just like random musings, some quasi memoir style, but somewhat fictional as well. I would like change up the names and make stories up, but always with like some lesson that I had learned because of something that had happened that day. And so, yeah.
that's really cute. It's like lessons in the size of a cupcake. Like, I thought of like a podcast name that I would want to do, like your sweet tooth auntie, and also like auntie wisdom kind of thing. So relatable. I love your book title. Yeah.
Yeah. So again, I think the audience and even myself, learn a lot about, investing, and also how your journey from doing a lot of different stage, even the operator, a lot of different stage in investing and learning, and a lot of insight about the industry. So thank you so much for spending the time here talking to us and sharing more with our audience.
We hope that in the future there'll be more female Vietnamese investors like you.
Yeah.
Thank you. I actually just met another one.
Who's that?
She's on the board of a company with me. She just joined. Her name is Ivy Nguyen. She just joined the board of a company that I'm on. So it was really great to see. I was like, oh, look, another female investor and also on a board. So that's just great for the industry.
It's awesome. I think on the SPAC side, there's also Mr. Chin Chu, who
Yes.
was involved with a number of SPACs back in the day and running his own firm. And then from that note, there's also Quyên Tran. She's held a number of roles in investor relations at different funds.
Love it.
Again, thank you so much for being here with us today, and we wish you the best on your journey, and really look forward to see even more fun and more advancement in your career, and hopefully we can have another opportunity to talk and learn more from you in the future.
Yeah, absolutely. Thank you so much for having me. It was a pleasure to meet all of you, and I'm so excited for you all and your careers. I think, even doing something like this is so cool. I love that, you're spending your time on your passions and hearing awesome stories. And I wish that, when I was earlier in my career, I had a community like this. So this is great. And I wish you all the best of luck as well.
Thank you so much, everyone, for tuning in, and looking forward to share and talking to more people and more cool people in the future. Hope to see everyone soon.
Thank you.
All right. Thank you, Vanessa.
Thank you.